From New York City for our viewers worldwide, I'm Sonali Basak, and Bloomberg Brill yield starts right now. Coming up, economic data continuing to show signs of slowing, but retail sales suggest resilient consumer spending. And Fed officials boost investor confidence in a September rate cut. But we begin with the big issue, betting on September.
The Fed is planning and gearing up to cut rates in September.
On course for September.
September cut.
September seems to be a lock.
I think it's not there yet for a July cut.
Won't move in July.
It looks like the Fed is going to cut rates amid this cyclical slowdown.
There is a good case that the Fed should be easing policy.
The data is certainly moving in the right direction and cooperating.
The top priority right now is inflation. Inflation's coming down better than the FOMC expected.
You have inflation that is cooling.
We're seeing inflation come down in conjunction with the economy, but simultaneously the economy hasn't collapsed.
It's not just inflation that's driving cuts now. It's the broader economy that the Fed is watching.
The market is well ahead of the Fed.
You have an unemployment rate that's creeping a little bit higher.
The labor market can turn very quickly, which is why I think Fed officials have to be cautious as they watch these data.
They're going to have to recalibrate as we go along, as they move away from restrictive policy.
Economists surveyed by Bloomberg trimmed their U.S. inflation projections through the first half of 2025 as they expect the Fed to start lowering interest rates. The Fed's preferred gauge of inflation, annual core PCE, excluding food and energy, is expected to now end the year at 2.6%, and that's lower than last month's projection and flat from a month ago. Overall, PCE price index is expected to end the year at 2.4%, so the direction of travel is indeed lower. Let's flip up the board here and take a look at another favorite trade of the market, one that just went wild earlier this week. That is that 230 curve. This is the curve steepener that people were betting on into Monday, with the betting odds of a Trump presidency increasing. You see over here the curve disinverted. We are back to being in inverted territory. A lot of questions about what the U.S. fiscal situation really means for that longer end of the yield curve. And remember, earlier this week, Fed Chair Powell spoke with Bloomberg host and Carlyle co-founder and co-chairman David Rubenstein. Take a listen.
On inflation, in the first quarter, we didn't make any more progress. The second quarter, actually, we did make some more progress. We've had now 3 better readings, and if you average them, that's a pretty good pace.
Joining us now, Karissa McDonough of Nottingham Trust and Ian Lyngen of BMO. And if you take a look at just what happened this week, for example, you saw those odds of a rate cut increasing when you looked at swaps, futures markets. And the market now firmly believes in 2 cuts. Do you believe in that, Ian?
Well, we're certainly in the 2-cut camp this year. September and December, we've been calling for that for some time, and it makes sense. We have now the data to justify it. We have enough signaling from the Fed that that's their preferred departure point. We'll get the updated SEP, and there'll be a lot of information that we have between now and September to justify a move.
Carissa, how do you feel when you looked at all of the information we had this week from Fed officials, from other types of economic data? Do you now reposition in any form with more conviction?
Oh, we definitely feel like 2 cuts is absolutely correct. Possibly, there's a possibility of maybe another one in January, but this is absolutely the time to be positioning for that trade. And it's not just the bull steepener; it's also possibly positioning in longer-term securities to take advantage of rates coming down across the curve over time. So yes, high conviction trade. The data is all there to support it.
And Ian, when you look at the market right now, is this more about what is happening with the Fed or what's happening in the political sphere? Some of the sharpest moves you saw this week came off the heels of this idea that Trump could be the next U.S. president.
Well, I would say that the bearish aspect of any steepening is going to be a function of what's going on in Washington and in the political sphere. The bull steepening, however, is a classic into-the-cycle trade, and that's the trade that everyone's been looking for this year. And so the fact that we now have an added steepening impulse in the form of politics, I think has really accelerated the move, and I still think that we get back into positive territory for 2s, 10s by the end of the year. It just might be a bumpy ride.
The bumpy ride ahead, too. Karissa, if you think about the bumpy ride it took to get here to begin with, how much conviction do you have in the long end, given that there could still be worries, particularly about the U.S. fiscal situation?
Excellent question. I think so much of that rests on kind of what happens politically, and that is a bit of a wild card. I think we have a fair degree more conviction of, again, Fed policy. You've had even Goolsbee just this week coming out, not wanting to risk kind of that golden path where both inflation and unemployment are at these places that are going to allow the Fed to execute on policy. So long yields, I think, yes, there's going to be some degree of additional volatility, but I think you can trade the steepener in terms of having conviction in that the Fed is set on its path. But yes, some degree of volatility, and we may have, we would expect to be in positive territory as well by year end.
And we talked a little bit about how some of that trade has reversed, that Trump trade, particularly as you saw it in the 230 curve. How do you read that? Has the narrative around a potential future Trump presidency changed?
I think that the knee-jerk reaction made a lot of sense. It was a classic curve steepener in a bearish form. We priced in more term premium. And if you think about the long end of the curve and the 30-year sector, assuming that Trump gets back into the White House, he'll probably bring in a new Treasury Secretary, and every new Treasury Secretary revisits issuing an ultra-long bond. And so there should be some type of conversation about that. Now, the flattening that then subsequently transpired, I think, is even more interesting because that's the market saying that they have confidence in the Fed that if we do have a reflationary spike in 2025, 2026, that they'll simply stop cutting rates or even recalibrate higher. So I think that that's the back and forth that the curve is telling us.
Well, it's interesting. Ultra long bond is really what makes your imagination start to perk up again, especially when you've seen so much issuance at the short end of the curve. Do you think that the Treasury could be successful in pursuing an ultra long bond?
I certainly don't think that this is the cycle for it, given where longer dated yields are at the moment. If one were to issue a 50 or 100-year bond, it would need to be when rates are at the lows, not at the highs. So I wouldn't think that that's going to be on the agenda for next year.
Karissa, how much risk is there? If you think about it, and another part of this trade has been worries about an inflationary impulse that could occur under a future Trump administration, what tariffs would mean, what lower taxes could mean once again for the bond market. Do you worry about that, and do you position accordingly?
You know, that is a secondary concern for us. That's certainly something that investors should keep in mind, that there may be some degree of reflationary pressure. But we feel very strongly that, again, the Fed has been fairly masterful here in terms of managing this cycle to the extent that they are able to kind of offset initial policy decisions on the fiscal side. I think they've done that before. They can do it again. There is nothing wrong with kind of keeping your duration neutral, but we're not necessarily positioning for that to be the likely outcome. What we do think is when you're in this kind of inflectionary environment, you get like the market is at a point where it could kind of go either way, really position for fat tails, a whole set of varied outcomes, which means, like safety, look at capital structure considerations. Safe yield is more important than high yield. Those are the kinds of things that we're looking at.
You think about, for example, just over the last couple of days, the worries we've seen from pronounced economist Jason Furman, for example. This morning we had Abby Joseph Cohen on air with us. And you have increasing worries also about the threatened independence of the Federal Reserve. Ian, I know this is something that you've been taking a look at lately. How do you think about that risk and what it would mean for markets?
Well, the first thing I'll say is that it's very unlikely that Powell resigns before the end of his term, which is May 2026. And so we will, at a minimum, have some continuity. Now, recall in 2015, 2016, there was an effort on the part of Congress to, quote unquote, audit the Fed. more of a meeting by meeting revamp of whether the decision was correct, how that might have been done differently, and that would materially undermine the Fed's independence. It would make it far more political. We hope and don't think that that is going to be the outcome regardless of who ends up in the White House, but that's something that needs to be on the radar, especially given all the uncertainties globally in terms of central banking independence.
Well, what would it mean for the Treasury market in particular if that were to be a bigger risk?
I think if it were to be a significant risk, we'd have to look at the rest of the world's confidence in the dollar as a reserve currency. And if the dollar, if their stances or its stance as a reserve currency came into question, that would mean higher rates. That would mean a more difficult time financing the federal deficit. And no one wants that.
Yeah, we've been talking a lot about the long term here, but even in the short term, Karissa, just let's go back a little bit here and talk about the consumer, the resilience of the U.S. consumer, the job market, any signs of weakening, and the remaining strength there is. How much do you read into the economic data at this point in the cycle when certainty on inflation has come to the surface a little more, this direction of travel of inflation being a little lower?
Yeah, well, I think the data, the top line data, does mask some variation underneath. I think the theme that we're looking at is bifurcation, whether you're looking at the bifurcation of the consumer or bifurcation of corporate borrowers. The data can tell you one thing in terms of general health, but there is a wide variety of actual health of the consumer underneath the surface. And I think that has real implications for kind of longer term economic growth. If the majority of the consumers are actually in a weaker spot. And similar to that, you've had a fair amount of corporations kind of term out their debt at very favorable rates, but that doesn't mean that the majority of borrowers are able to do that. And that could mean issues for the credit market down the road. So again, when you have this bifurcation, this variation, you really need to position for potential volatility of outcomes. And that's what we're recommending to clients.
We'll talk much more about that bifurcation. But at this point, it's interesting. You mentioned, Ian, some serious concerns down the line. We didn't ask you how you felt about the longer end of the curve.
So longer term, I'm actually constructive on 10s and 30s. And the logic here is relatively straightforward. We just saw decades high levels of inflation because of the pandemic and the fiscal response and everything associated with that. Fed funds only got as high as 5.50. We didn't get to 7. We didn't get to 10%. And so that means that over the course of the next few cycles, assuming there's not pandemic high inflation, that's going to be an upper bound. And that gives the market a reasonable amount of confidence to know where policy rates are going to be. Sure, we're going to get a little bit of positive term premium, but at the end of the day, the range that emerges over the course of the next couple of years is going to resemble what we were in 2018, 2019. Very familiar levels.
Ian, in a world that is so uncertain, having that upper limit is certainly a relief. That is Karissa McDonough and Ian Lyngen of BMO. We thank you both so much for your time, and happy Friday to both of you. Up next, we're going to talk about the auction block. Major U.S. banks issuing nearly $45 billion in high-grade debt. We're going to take a look at the credit markets next. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. And it's time now for the auction block, where we kick things off in Europe. Widespread outages is keeping issuers on the sidelines this Friday, capping weekly issuance in Europe at about 18 billion euros. And over in the U.S., 4 of the 6 major banks issuing nearly $45 billion in high-grade debt, marking the busiest weeks in 2 months. But a different story on high yield, just 4 different borrowers coming into market, raising $3 billion as the summer lull takes hold. And Nuvine's Tony Rodriguez weighing in on where he sees credit spreads going from here.
Credit spreads are probably going to widen a bit from here over the next couple of months. You have volatility coming in from the election. You have the economy slowing down. We've been in a golden age of credit in terms of defaults, for example. So credit's weakening, but we don't see a kind of recession-like environment for credit. Defaults, we think, will rise, but stay below long-term averages. So that means you should see some widening in credit spreads because we may be a little bit overpriced here.
Let's bring in Matt Brill, head of North American Investment Grade Credit at Invesco. And Matt, you looked at the beginning of the year. The first half was just flush with issuance. What do you expect for the second part of the year?
Yeah, good afternoon. And first off, this has exceeded everybody's expectations pretty much every month all year long. It's come in more than what the forecasts were for supply. But we're up about 30% overall. But most of that has been financials. So financials, as you stated, it had a really big week this week. I actually thought it could have even been bigger. But year to date, you're up about 50% year over year for financials. And given where we were last year, I think banks just saw the opportunity. They didn't know if we'd go back into a mini banking crisis from a capital market standpoint. And so they borrowed, and they borrowed as much as they could earlier in the year. And now I think spreads are very, very tight, or not very tight, but have come in a lot for banks. And I think they're kind of at the end of borrowing. So I think going forward, you should see the financial issuance be reduced, and you should see industrial issuance come down significantly as well.
What does that mean for a credit investor at this point in time? If new supply starts to slow down, what do you chew on?
Yeah, so negative net supply is kind of the term that is being thrown around out there. And that basically means coupons, maturities, and minus new bonds. And so we actually think there will be less supply than all the coupons and maturities that are out there. So it creates, hard to believe this, but it creates a little bit of scarcity value for bonds, and particularly for high quality credit. That will really be dictated, though, on what the demand is going to be. So retail demand, we expect to pick up considerably the back half of the year. Particularly when the Fed actually does cut for the first time. Institutional demand is a little trickier for us to forecast because yields were so attractive for institutional investors, pension plans, annuities, insurance companies, that we saw massive demand all first half of the year. I think that could slow a little bit the second half of the year. But at the end of the day, 5+% for investment grade credit is still attractive. So I think there will be demand, but I do think there will be certainly less supply.
It is hard to believe, this idea that things could become part of a scarcity value story only because of what you were saying about spreads. And so if you have this issue where the valuation doesn't work out for a lot of investors, and you have the scarcity value that could draw more money into parts of the credit market here, do people start really stretching for risk?
Well, I think that it's a concern for sure. At these current with the market, or excuse me, the economy where it is today, it's not a big risk near term. But yeah, if you start to see people do more aggressive purchases, if you start to see companies, it'd be more concerned to me, have a more aggressive financial policy due to all in tighter spreads, that would be a concern. But overall, what we're seeing is still very balanced. For today, for example, Occidental Petroleum probably going to come with a large deal next week for an acquisition. But they're selling off part of their assets as well, and that will enable them to not have to borrow as much debt. So we're still not seeing corporations just say, I'm going to be aggressive, I'm going to go all in due to the cheap financing that's out there. If we see that, that would be a concern. But overall, we're still seeing fairly prudent from companies, and then the risk taking by investors. Yes, there's money flowing into high yield. I think that's very normal, but predominantly it's in the higher quality of high yield. EM seeing flows that are fairly muted. So it doesn't feel to me like people are reaching yet, but it's something to keep an eye on as we head into 2025.
How firmly do you feel about this economy? Because if you think about it, people are already reaching for risk in a lot of ways. And if you think about just where credit ratings stand, a lot of people are so sanguine that they're not seeing a whole lot of risk there to begin with. How do you see it?
Well, the trajectory is quite positive. So you're seeing about 4 to 5 times upgrades into investment grade versus downgrades, fallen angels. We're not seeing a lot of that. Now, obviously, that's a little bit backward looking. I think there will be a time here as the economy continues to slow that we're gonna see a little bit more balance there. But overall, the economy is very good, and the banks, this week are issuing, and it's essentially a derivative of the economy. We need to see a strong economy in order for banks to do well, but we don't need to see 4, 5, 6% nominal growth. We really just need to see positive nominal growth, positive real growth. And I think that's the difference in the market going forward, is that you're going to see growth, but it's not going to be the level that you saw the last several years. And that's not what you need for the fixed income market. The equity market needs material growth. The fixed income market just kind of needs you to muddle along. And a muddle along economy is not bad for overall fixed income. So if we see a hard landing, and our projections the entire time have been for this soft landing, if you see a hard landing, credit spreads are not compensating you. I'll be very clear about that. But that's not our base case. We think that that's actually a very small percentage probability at this point. So getting paid 80 to 85 basis points over treasuries to own investment grade credit, getting 5+% to own investment grade credit when fundamentals are still very good. We're relatively constructive on it still at this point.
What is the risk, Matt, at investing when credit spreads are still this tight?
Well, the risk is, quite simply that you're wrong, and that the economy hits the hard stop. As I stated, credit spreads at 80, 85 basis points are not compensating you for it. I will point out the quality of the investment grade market, the quality of the high yield market as well, has improved considerably. So, you're down to about 10% of the investment grade market is in BBB minus credit. So that's the lowest we've been in about 15 years. Your portion of BBB credit is the lowest it's been since 2015. It's down nearly 10% from its highs. So you don't own, or the market doesn't have, the lower quality credit that it had in the past. So if you go into a recession, or if the economy were to have a worse period of time than expected, I think credit spreads will go wider. But I would point out that I still think defaults will be low, and I think just the overall credit quality is at such a high quality starting point that you're set up for a buffer, even if you do get things to be worse than expected from here.
Matt, 30 seconds here. Favorite trade in this market?
Oh, favorite trade. Well, we've loved the energy space. We've loved the bank space. At this point, I think you got to start dialing back regionals and go more into the big six. So I'm still going to be long banks, but I think the regional bank that we've been such a fan of has come quite a distance and has kind of played itself out. I'm not worried about it, but I just don't see the upside here at this point.
Matt, thank you so very much for your time. Happy Friday. Happy weekend to you. Now, still ahead, stick with us. The final spread the week ahead. Investors awaiting the Fed's preferred gauge of inflation. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield, and it's time now for the final spread the week ahead. Coming up, the Fed is entering its blackout period after today, and Monday, Verizon kicking off a very busy week of earnings. Tuesday, we'll get results from Alphabet and Tesla. Wednesday, U.S. PMIs rolling out, followed by initial jobless claims and GDP on Thursday. Plus, American and Southwest Airlines reporting earnings, and finally, Friday, the Fed's preferred inflation gauge. And for my final thought, let's take a look at those PCE estimates here, because of course we are watching a market expecting to come in a core deflator year over year at 2.6%, essentially flat from the prior estimate. Remember, direction of travel, economists believe, is still lower. That deflator month over month on a core basis only expected to be about 0.2% higher. And from New York, that does it from us. Same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg.